Right now, we are watching active combat systematically dismantle the infrastructure we rely on. Missiles are flying across borders, striking power grids and energy hubs. This map shows the Strait of Hormuz. It is a 21-mile stretch of water between the Persian Gulf and the Gulf of Oman. When a bottleneck like this gets choked off by military ultimatums, the global energy market freezes. That physical disruption overseas instantly bleeds into the US markets. You have traders staring at screens, watching a $28 trillion economy try to price in a simultaneous energy squeeze and a tech sector contraction. The macroeconomic shocks piling up in 2026 are heavy. Hormuz blockades, sudden defense spending surges, and violent AI pullbacks are all converging at exactly the same time. This atmosphere of crisis pushes energy prices and tech valuations to react to 48-hour political deadlines as much as they do to traditional supply and demand. When oil swings 10% in a single afternoon because of a missile intercept, jumping in feels like a logical choice. You look at the news and assume you can buy defense contractors today and short airline stocks tomorrow. Everyday investors cannot outrun the speed of institutional money. By the time you hit buy, Wall Street's algorithms and hedge funds have already moved the market. Wealth protection in this environment relies on a boring offense. It requires a long-term strategy designed to survive the shockwaves, rather than trying to perfectly guess when they will hit. Surviving the crisis means giving up the illusion of short-term control and relying instead on the mathematical certainty of risk management. To see how different strategies hold up, we can evaluate them through a framework comparing the inputs required against the actual outcomes and trade-offs. We start with active speculation. The inputs involve heavy daily monitoring, betting on sudden tariff announcements, or pouring capital into volatile space and AI tech sectors. The expected outcome is the adrenaline of feeling in control, paired with a slim chance of rapid returns if you happen to guess correctly. The trade-off is that you are competing against supercomputers executing thousands of trades a second. When you get it wrong, your portfolio faces a high probability of a complete wipeout. This chart shows the sharp crash of March 2020. It proves how fast institutional money pulls out during a black swan event. The drop is violent, sudden, and leaves active retail traders trapped at the bottom. In the geopolitical casino, the house is designed to win. The second path available is system-resilient assets. The input is taking your capital off the commercial banking ledger. You move it into scarce physical holdings like remote real estate or precious metals. This strategy provides financial insulation. You're protecting your purchasing power from currency instability, inflation spikes, and banking freezes. Major institutions have been quietly hoarding physical gold, driving prices up roughly 70% recently. They want assets that cannot be artificially printed or easily confiscated. But the security comes at the cost of liquidity. You cannot easily spend a gold bar, and you are entirely giving up the high-yield compounding growth of the stock market. These physical assets act as a heavy shield to preserve your existing capital, but they won't grow it quickly. That brings us to the final evaluation path, the always be buying protocol. The input requires you to automate a fixed percentage of your income directly into low-cost, broad market index funds every month, ignoring the news cycle entirely. The outcome is that you naturally buy the dip when the market panics and capture the full upside when it recovers. Over decades, compound interest does the heavy lifting. The trade-off is psychological. It is grueling to watch your portfolio bleed red during a massive market shock and do absolutely nothing. You have to endure unrealized losses without panic selling. The most successful investors in history operate this way. They sit quietly through wars and recessions, letting their diversified assets slowly absorb the volatility. Patient, long-term market consistency outlasts geopolitical noise. A portfolio's survival depends on assets built to endure market shocks, regardless of your ability to time them. We can map your capital deployment directly to your personal risk tolerance. If market volatility keeps you up, stick strictly to the ABB protocol. Buy broad market index funds every month and keep emergency cash reserves. For wealth preservation, shift a dedicated portion into physical gold as a firebreak against currency instability. To speculate, target high-growth AI or space ETFs with capital you can afford to lose, but leave your core index funds completely untouched. While the economy moves through this shift, your most effective move is to refuse the gamble, manage your risk, and let the compounding clock run.